The purpose of this microlearning is to share the latest developments with the Goodwill Impairment Test the FASB implemented to reduce cost and complexity. A quick summary. It simplifies the Goodwill Impairment Test by eliminating Step 2. Early adoption is allowed for measurement dates on or after January 1st, 2017. There are special considerations for private companies that have elected one or both of the private company alternative treatments related to goodwill and intangible assets. All of these will be discussed later in our presentation. Hello, my name is Kelly Atkins and I am a Managing Director in KPMG's National Office.
And I'm Greg Pierzenka, a Senior Associate in KPMG's National Office.
So let's take a minute to go through the changes that the FASB issued. The biggest change here is the board decided to simplify the impairment test by removing the requirement to perform Step 2. The board received feedback from users of the financial statements that they aren't necessarily as concerned with the exact measurement of impairment as they are the existence of impairment. So under the changes, impairment is measured as the amount that the carrying value exceeds fair value. The maximum impairment charge is limited to the carrying amount of goodwill that's allocated to a reporting unit. So because Step 2 is being removed, the board reworked the subsequent measurement of reporting units with zero or negative carrying amounts. Under these changes, these reporting units are subject to the same impairment assessment as reporting units with positive carrying amounts, and there's no required qualitative assessment. However, they will be subject to a new disclosure requirement, which will be discussed on a later slide. If applicable, when performing the test, an entity will need to consider the related income tax effect from any tax-deductible goodwill when measuring the impairment loss. Let's discuss some examples.
Let's consider a reporting unit that has a carrying amount of $90. As you can see on this slide, we derive the carrying amount by taking $60 of net assets, excluding goodwill and deferred income taxes, plus goodwill of $40, less the net deferred tax liability of $10. Using market participant assumptions, the company concludes that the fair value is maximized by selling the reporting unit in a non-taxable transaction. The entity determines the fair value of the reporting unit to be $80. Under current GAAP, we would say that there is an indication of impairment under Step 1 and move to Step 2 to assess if goodwill is impaired and by what amount. However, under the ASU, the goodwill impairment charge is simply $10, which is calculated as the reporting unit's carrying amount of $90 less its fair value of $80. Thus, goodwill is reduced from $40 to $30. Remember, the maximum amount of goodwill impairment is limited to the carrying amount of goodwill for the reporting unit. If the carrying amount of the reporting unit had exceeded fair value by $50 rather than $10, the impairment charge would have been $40 and goodwill would have been reduced to zero. Please note, the ASU requires entities to always consider existing deferred tax balances in the carrying amount of the reporting unit. Now, let's consider a reporting unit whose goodwill is deductible for tax purposes. In this example, the carrying amount is $1,000 and the fair value is $900, which would indicate an impairment of $100 if goodwill is non-tax deductible. However, when goodwill of a reporting unit is tax deductible, the impairment of goodwill creates the need to solve a circular calculation because a decrease in the book value of goodwill increases the deferred tax assets such that the carrying amount of the reporting unit increases. This example illustrates the use of a simultaneous equation when tax deductible goodwill is present. A quick way to calculate total impairment through the simultaneous equation is simply taking the initial impairment and dividing by 1 minus the tax rate. The deferred tax asset is then equal to total impairment less initial impairment. As shown in example 2, the company reports a $167 goodwill impairment charge, partially offset by a $67 deferred tax benefit. Once again, if the impairment charge calculated using the equation exceeds the total goodwill allocated to a reporting unit, the total impairment charge is limited to the carrying amount of goodwill. Now, let's consider the disclosure requirements for the ASU. In the fiscal period in which the ASU is adopted, disclosing compliance with the ASU satisfies the disclosure requirement as to why the change is preferable. An entity that issues interim financial statements is required to disclose the change in both its interim period and the annual period of the change. In addition, entities are required to disclose reporting units with 0 or negative carrying amounts, the amount of goodwill allocated to each of these reporting units, and the related reportable segment.
Many private companies may have adopted the alternative treatment for goodwill because they find Step 2 of the general goodwill impairment test too burdensome or costly. As a result of this new ASU, some private companies may wish to discontinue applying the alternative treatment and resume testing goodwill annually for impairment at the reporting unit level. A private company that has elected only the alternative treatment for goodwill is allowed to adopt this ASU prospectively without having to justify the accounting change as preferable, using the remaining unamortized balance of goodwill as its new cost basis. However, we would expect a private company that anticipates filing with the SEC to adopt this ASU retrospectively. A private company that has also elected the alternative treatment to subsume certain identifiable intangible assets into goodwill may only adopt this ASU following the general guidance in ASC 250 on changes in accounting principles, including justifying the change as preferable and adopting the change retrospectively. Here is the transition guidance for the following business entities. Note that early adoption is permitted for measurement dates on or after January 1st, 2017. We'd expect most companies to early adopt. However, there may be circumstances where a reporting unit fails Step 1 under the legacy standards, but would show no impairment under Step 2. If this happens, we would not expect the entity to early adopt. Keep in mind, companies need to apply the same impairment model consistently to all goodwill impairment tests performed within a fiscal year, except for interim tests performed as of a date before January 1st, 2017. Thank you so much for listening today. We hope you found this podcast informative.